Hello and welcome to Asset TV's Masterclass with me, Mark Colgate. Today we are looking at emerging markets. It's an asset class that has, I think it's fair to say, disappointed in the last decade compared to developed markets. But are things about to change, not least with the amount of stimulus going to the market in China? Well, to discuss that and other topics, I'm joined here by three fund managers, all experts in the region. Let's meet them. They are Dominic Bokor-Ingram. He's Senior Portfolio Manager at Fiera Capital. We're also joined by Glenn Finnegan, Lead Portfolio Manager and Co-Managing Partner at Skerryvore, and by James Donald, Head of Emerging Markets at Lazard Asset Management. Dominic, can you tell us a little bit about how you run the money at Fiera Capital and what's the base case for looking at global emerging markets today?
Our base case really is that emerging markets we don't consider an asset class and rather an opportunity set. And I think that's one of the reasons why the whole asset class, if you like, has disappointed so much over the last 15 years. So what we're really looking for is to invest in those places in the world that are going through reform processes, creating growth. And then most importantly, trying to find companies where we are aligned with the founders, the majority shareholders, and where we can find growth companies at attractive valuations in countries that are changing rapidly and actually doing what emerging markets were meant to do, which was emerge. I think the asset class has been hamstrung, I would say, on a general level by including countries as diverse as China and Egypt in the same benchmark. I think it makes much more sense to look at an opportunity set and see where at any particular time the growth is, and then how we can extract that growth through finding the right companies.
Thank you. Glenn, can you tell us a little bit about how you're running the money at Skerryvore, how you think about global emerging markets, and where do you see the opportunities and the threats today?
Yeah, certainly. I mean, we're very much bottom-up stock pickers in the developing world. So we're looking for businesses that give us a decent shot of compounding our clients' capital from what is quite an interesting demographic backdrop in a lot of emerging markets. You have young, growing populations, quite low levels of consumption of lots of products and services that you would expect would grow over time. So trying to find ways that we will be allowed to benefit from that opportunity is very much at the heart of our stock picking. So similar to what Dominic said, looking for management teams, ownership structures that have demonstrated long track records of acting with high levels of integrity and alignment with their shareholders. Will you be allowed to benefit? That's sort of the first question that we ask. I think the headwind for EM that's existed over the last more than 10 years is it's partly governance. A big portion of the index, we would argue, if you looked at it on a stock-by-stock basis, you probably wouldn't put your own money in many of these businesses. They are not necessarily run to generate wealth for their shareholders. They might be state-controlled oil and gas businesses that operate in the national service. They might be state-controlled banks that will do the politicians' bidding rather than think about really returns for minority shareholders. So I think there's been that sort of governance headwind, and also currencies have been against you as well. So I think trying to correct the opportunity set for weak governance and misalignment, and also focusing on real pricing power. So franchises that are able to grow in real terms and stay ahead of some of these devaluing forces that have been against the asset class. That's really at the heart of what we're trying to do. Strong franchises with pricing power, honestly run businesses that we can feel truly aligned with the ownership.
Thank you. James Donald, what's your take on the opportunity set at the moment? And do you see any catalysts for higher returns from it?
Well, I mean, we at Lazard have a lot of different strategies. I'm a believer that no portfolio manager can outperform all the time, and that investors are interested in different things. So, on our platform, we have a quantitative strategy, we have a growth strategy, we have a core strategy. My strategy is a quality value strategy. Mm-hmm. So we are very focused on valuation, and we're only interested in companies that typically have high and stable levels of return on equity over time. We are pretty governance focused. We've had a governance part of our process for 25 years now. And so we look pretty closely at that. And in emerging markets, we do have a natural disadvantage from governance in that the vast majority of companies in emerging markets have a control investor. So essentially, we're on the outside to start off with. But we are really looking for underappreciated opportunities based on profitability, and we're only interested in mispriced securities.
But at some point, James, let's assume you get a fantastic company. It's got great governance. You got in because it was underpriced. At some point, you're looking for a catalyst. Typically, what are the catalysts in emerging markets that make that go up? Is it a flood of foreign capital coming in? What is it?
Not usually. I mean, undervaluation or underappreciated situations can occur for long periods, and you can have catalysts that appear that, quite frankly, aren't easy to see them appearing, but they do occur. A good example of that would be what's happened in South Africa in the last 4 months, in that you had a long period in which the politics and the macroeconomics was pretty negative, and people lost interest in the South African market. And by and large, valuations were pretty inexpensive, but it was a frightening country for a lot of people to invest in. You've recently had an election where you've got a coalition, and it looks like things could be run a lot better in South Africa. Maybe not wonderfully, but a lot better. And that's acting right now as a catalyst to attract a lot more interest in that market.
Well, on that point, Glenn, say emerging markets, I mean, let's all accept that's a very broad opportunity set. But how do you think about the impact of government on this as an area? Because you said, I know you're a stock picker, but presumably if you get a government in emerging markets, it can be quite radical when a new one comes in. I mean, we've seen that, say, for example, Milei in Argentina. I mean, the mood music can change pretty quickly. How do you factor something like that into your thinking and your equations?
Yeah, I mean, a big part of our stock picking is to stay as far away from government as possible. We're looking for businesses that operate in sectors that are less influenced by government policy. We explicitly exclude government control, and there's a lot of that in emerging markets. But even governments where companies where you're heavily reliant maybe on government contracts and things like that, we're quite wary of that sort of thing. It often is associated with standards of governance that we wouldn't necessarily be comfortable with. So we're very much looking through the lens of privately run businesses, and largely we like businesses that get their license to operate from hundreds of millions and millions, and in some cases billions of consumers choosing their products and services because they're superior in one form or another. So we try and stay away, and so we're less focused on sort of government policy and more focused on businesses addressing their own idiosyncratic growth opportunities. It could be consumption of soft drinks in West Africa. It might be the electrification increasing investment in the electric grid in Brazil. It might be, but these are sort of they tend to be more private businesses away from government.
No, I take that point, but let's say you find a business like that, and then 2 weeks later you turn on the TV and the new president turns up wielding a chainsaw. I mean, does that have an impact on the stock price? If so, do you have to go back and retest your thesis?
You see short-term volatility, and very often that sort of creates opportunities. I think there's an interesting case in Mexico at the moment where the market hasn't particularly liked the result of the election, and that's potentially creating a valuation opportunity around one or two extremely well-run sort of consumer-type businesses that aren't directly impacted, may even be beneficiaries of sort of slightly more populist policies. So I think, yes, the volatility within EM politics can create opportunities for investors in decent quality private companies. But the one thing I would say is that at the heart of everything we believe is that you shouldn't be making a compromise to invest in the developing world. It shouldn't be that you have to accept government interference or substandard standard. There are global leading businesses operating out of the developing world, many of them, and at times they are reasonably valued, and that's when you should be investing.
Thank you. Well, just picking up on that, you're obviously run money slightly differently from each other. But Dominic, taking that point from Glenn on, how many companies are there potentially you could invest in a global emerging market? So once you start stripping out the poor governance, broadly speaking, those which are reliant on government influence and so forth, what does that take you down to?
If we start with a universe of 37,000 companies that we could potentially invest in, and we take out the ones where we don't think corporate governance is aligned, where we don't think have the right business model, which we think are in the wrong countries, and we will exclude countries if we think that the top-down incentive structures are not commensurate with minority shareholder rights. And then you screen out for valuations or debt levels of companies that you wouldn't invest in. We come down to a universe of about 2,700 companies, right, which we consider, as of today, could be investable. And from that, we're trying to get down to a portfolio of 50 to 60 companies, which have gone through our due diligence process and meet our requirements both in terms of quality and most importantly, valuation.
And I mentioned at the start, just broadly speaking, emerging markets had a tough decade. I had some figures here from Robeco saying returns for emerging market equities over a 10-year period to the end of June 2024 have lagged those of developed markets by an annualized average of 7% a year. So, James, is that because emerging markets have been having a tough time in the round, or is it because developed markets have been having a brilliant time, or a bit of both?
Well, I think it's a bit of both. I mean, the US has had an amazingly strong period of time, particularly in technology. And as Glenn said, emerging markets have been impacted by various effects. I would say to some extent governance. I would say political risks have had a big effect. I think also in emerging markets, you had a period of very high capital expenditure from 2010 to 2014, which wasn't successful, essentially. You didn't see higher revenues from that. And as a result, you saw a decrease in profitability that was an important negative in those markets. And as a result, this has been an asset class that has performed poorly.
Thank you. I mentioned a little bit at the start, China. Obviously, the emerging markets are much wider than China, but I just want to get a sense of how your thoughts on that. We've had this huge amount of stimulus. The Chinese market has certainly short-term had a bit of a bounce. What impact does that have on your overall asset allocation and what you then do at the sort of stock selection level? Are you adding in? Are you cutting back? Dominic, let's start with you.
Yeah, I mean, China is one of these markets where you have to try and avoid the politics, and you have to really try and find the private companies that are benefiting from actually the very good things that are going on in China. And by very good things, I mean from a population perspective. If you go to visit Chinese cities, most tier 1, tier 2, tier 3 Chinese cities, they're really nice places. They're clean, everything works, they're safe. And so from a population perspective, on average, people are having a better experience than they did. And you have to try and detangle that from what is going on at the top level politics and the way the politicians think that the country should be run. It makes it quite hard to find investable opportunities where you do really have a chance as a minority shareholder to get properly rewarded for what you do. So we try and kind of ignore the top-down news. I mean, at any point in the next 6 months, year, as we've seen in the last 6 months, year, 2 years, the government can come out and say something that will not fundamentally impact the direction that China is heading, but will impact in the short-term stock prices. The longer-term stock price chart will still be correlated to earnings growth. And so what we try and do is focus really on finding the right companies, again, at the right valuations and sticking by that. And a 30% bounce will make stocks more expensive. If we can't find a fundamental reason why the fundamental value goes up 30%, then we will be trimming. If we can, and we think there is a fundamental change and there's a higher growth rate than we previously expected, but we wouldn't expect to get to that point within a week, then we might add. But I don't, and unless we think there's a kind of permanent change in the way China's developing, which I don't think there is, then we're back to our fundamental bottom-up work, and that's what ultimately will pay in the long term.
So have you got an example you share of a Chinese stock you're invested in that you think is, if I say it does what it does, regardless of the politics that goes on?
Yeah, I think there's stocks that are particularly related to things like domestic travel, where government policy can, at the margin, determine how much money is in people's pockets, how confident they feel about spending. But whether it's airlines or local tourism companies or hotel companies, generally, they're going to benefit to the same degree based on how well China's doing overall and how well, particularly, the company management is able to implement their business plan. So it's not really a top-down call on China, because the direction of travel is not going to change.
Okay, thank you. Glenn, what's your take? Is that, first of all, is it a market you typically are overweight in against the benchmark, or underweight?
No, traditionally we've had a sort of moderate exposure to China, and we've been very valuation sensitive. We're valuation sensitive investors everywhere, and what we observed in China through the COVID period was the inflation of an enormous stock market bubble. The relatively short list of private businesses that we think might be interesting, many of them trading on north of 100 times PE. So the place sort of became uninvestable from a valuation perspective. So we found ourselves pretty well zero exposed to China sort of around about 2021 time. That's obviously changed. The Chinese stock market has cratered since then. And with the government now obviously trying to put a bit of a floor under that. But a lot of that unraveling was a bubble deflating. We've recently returned from a trip to China, and what is staggering is obviously the most visible impact of the decades-long boom is the oversupply of property. You can see that it's visible. It's lots of it in the wrong places and empty. But actually, there's oversupply of everything. There's oversupply of consumer companies. There's oversupply of brands. There's oversupply of biotechnology companies trying to invent drugs. So the impact of the boom is still sort of washing through. And yeah, to Dominic's point, working through that is going to take time. So I think that there's quite a few sort of headwinds that to some degree government policy is probably pushing on a string a bit, but they probably are in a position to put some sort of a floor under a market that had sort of very substantially derated. In terms of the types of things that we're looking at, there aren't that many Chinese businesses that meet our governance sort of bar. Our largest position in China is an operator of pharmacy chains, and that is a privately controlled, a founder-led business where the founder still owns a significant share. And pharmacy in China is still a very fragmented business, not like here where it's very corporatized. And that over the long run, that one would imagine that the process of corporatizing that sector will continue. And we think that the business that we own, a company called Yifeng, is one of the more conservative consolidators within that sector. And it feels like an opportunity that can compound sort of irrespective of many of the sort of headwinds that exist in the economy there. We stay away from obviously government control, but we're also not really interested in participating in the sort of state allocation of capital as well. So whether it's batteries or EVs or what have you, those aren't really opportunities we think are particularly interesting.
Is there any danger in a world where there's overcapacity and consolidation is needed that you end up backing a deal junkie?
Well,
how do you sort of make sure that your fish is getting bigger, but all of a sudden around the corner comes a much, much bigger fish?
Yeah, absolutely. I mean, we're very much about trying to identify management teams with a sort of risk appetite on a par with our own. So where we see examples of businesses that have stretched their balance sheet and what have you historically, they tend not to be businesses that make it onto our watch list. So we have 35 holdings in our portfolio, of which about 4 are in China today. And it's very much about trying to identify the ones that have the best shot at long-term compounding with the minimum amount of sort of financial balance sheet risk that comes with that.
Thank you. James, can I get your thought on it as a market at the moment and what this stimulus package means or potentially means for foreign investors?
Yes. Well, China's been a considerable challenge for us over time because we're really only interested in what we would say are quality businesses with high and stable profitability. And although China's a big market, the portion of the market that's in that area is relatively small. And because investors have been so keen to be invested in China for a long time, it's meant that the valuations have been pretty high. So, for instance, if you went back to 2006, 2007, we actually had a period when we had nothing in China, although it was the biggest market in emerging markets. And even 4 years ago, we had much, much less than, say, the index weight, which we received a lot of scrutiny for, I can tell you, because especially with the A-share market coming in, people thought it was just a matter of time before it was a majority of the index. Obviously, a lot of things have happened since then. We've had this huge derating for I think, fundamental and political reasons. And even high-quality companies today are at valuations that, quite frankly, I never thought they'd get to. I mean, we've got 15 years ago, if you remember, the big trends in the world were the Chinese consumer, the pharmaceutical industry in China because of the likely aging and now the aging of the population, and the internet. And we find multiple opportunities now in all three of those areas that to us look extremely good value. So recently, in the last 6 months or so, we've actually gone to a situation where we actually have more than the index weight for the first time in the strategy's existence.
Well, I suppose the other market, the other extreme, is there's been a lot of talk about sort of China, is it too cheap? And then the other one is India, is it too expensive? But it seems like an easier place to do business, and it has more of perhaps a capitalist vibe to it. I mean, Glenn, again, I know with the proviso, everyone's a stock picker, but just in terms of that as an environment in which to look at stocks, what's your take on India at the moment?
Yeah, from the very high level, I mean, India is a very broad, very deep market, lots and lots of private companies to choose from. So that does make it somewhat different to China in the sense that it seems it's easier to run a business completely sort of independent of government in India. Clearly, the market there has done extremely well, and I think there are bubble-like characteristics within India. It's not an unwarranted boom. There's huge infrastructure investment taking place. There's been the well-known story of supply chains realigning, a bit diversifying away from China. India's clear beneficiary, and the infrastructure going in to support that. So there's good reasons why people have got excited about stocks in India. We would caution on valuations, though. I think after a very long run, we'd highlight many consumer companies trading on extremely high multiples, domestic infrastructure type businesses trading on very, very high multiples. I was just looking yesterday morning at a subsidiary of ABB, a leading global industrial business. Their subsidiary is listed in India. It's trading on, I believe, over 90 times next year's earnings. So these are multiples where it's quite hard to argue the potential for making strong absolute returns seems quite challenged. Now, on the flip side of that, there is it's a very broad market in India, and there are sectors which I think are less caught up in that. I think the IT services industry in India, where India is a global leader, some of those businesses remain quite reasonably priced with very strong cash flow yields. I think within pharmaceuticals and healthcare, there's some interesting opportunities in India still, where the valuations haven't really got wrapped up in that domestic sort of bubble type of environment. So, yeah, I think one needs to be very valuation sensitive when thinking about India, but the reasons people are excited about it seem quite well founded. The growth story is genuine.
The quick follow up, if I may. I think you've got Tata Consultancy as a holding. There's obviously quite a lot of Tata companies out there. It's a family that very entrepreneurial over a very long period of time. Are all of those companies completely separate from each other, or are there cross shareholdings? Is there a little bit that everyone's going to love it, and at some point, 15 years' time, everyone's going to go, "Oh, this is very like Korea and Japan. It's sort of chai bowls, but a bit different," and a lot of the gloss comes off all at once?
Yeah, I mean, the Tata Group is a very long history, obviously, in India, one of the biggest industrial houses in the country, and actually, it's not so much family control; it's more within a foundation now. So, in some ways, a lot of the governance questions that you might have if it was a sort of an Adani group or something like that are kind of behind it. But what I would say is the businesses are all extremely professionally managed. The chairman of the group is a professional who's come up through the group. And I think, the best way is to study history and study track records and look, have minority shareholders in Tata Consulting Services always been well treated? Is there any history of sort of governance missteps? And the answer is we can't see any. I mean, the track record has been exceptional. Think about what they've done. They've gone from we like finding companies all over EM like this. They've taken an emerging market advantage, which was cost, and they've turned that by reinvesting in their own capabilities over decades. They've turned that into a global leading multinational franchise. So I think it'd be quite hard to criticize Tata from a governance perspective.
Joe, just on that point, as emerging markets emerge, I mean, how many global leaders rather than national champions are you coming across as potential investments now?
Well, I would say it's an increasing number. We've certainly over the last 20 years seen some major companies become global leaders in world industries. So much more than, say, we had in the 1990s.
But does that have a knock-on effect? I mean, if I think back to the 1990s, there was this idea of this sort of primacy, predominantly of American brands, but also of European ones that were going to dominate. And then as consumer societies developed, you've seen big consumer brands coming out of places like China and so forth. To what extent do you spend some of your time saying to your developed market colleagues, that stock you've got, it doesn't have the growth runway you think? I'll just, not saying it to be nasty, but just on the QT.
Well, I think they're interested as well in these companies. It's not easy being an emerging market company. You've typically got a higher cost of capital, so becoming a big player in the global world is not an easy situation. And so, for instance, a company like Cemex in Mexico is now one of the probably 3 world leading cement companies. But there have been times when it has been very difficult. They've made acquisitions, not least in this country, of businesses, and they've cost them a lot of money and added debt, and they've had to work through those periods, which have been quite substantial in order to get through it. But they're today very, very strong businesses.
Thank you. Dominic, can I get your thoughts around India? I mean, obviously a lot of very good companies, but as you look at the market today, are they good investments or?
Good investments always a tricky one. I think generally we find the Indian market a little bit expensive on the whole, and particularly amongst the larger stocks. There are certain parts of the market where we see value, and in some ways they're aligned with what the government is trying to do. I mean, if you look at the power sector and the amount of investment that's gone into the power sector, India has been an emerging market that's been very exciting since the early 1990s and never really happened until the last few years. And I think it's the different focus from government on infrastructure that's really driven the ability for companies then to set up and to have the amount of power and the banking requirements and the legal requirements that they need to set up. And so investment in the power sector has been a massive driver of what we've seen in India over the last few years, and that continues. And there are a number of private companies in that sector where you're to some extent exposed to government policy, but the government policy clearly and the incentive is to allow as much power to be created as possible. We also think that in the banking sector, and particularly in the non-bank financials, there is massive runway. I mean, we're in a country with very low GDP per capita compared to most other emerging markets even. And the unbanked sector is probably larger than any other part of the emerging market world in pure numbers, but is developing so fast on the back of the generations of technology that have been missed, if you like, or not had to happen. And so you have a growth profile in some of these sectors that is way beyond what we have experienced in emerging markets before. And I think that's one of the key challenges for us and the key opportunities is to work out where current policies that look like old policies actually create much more growth today than they have done in the past.
But a skeptic might say, great, you've got some technology, but if there's a lot of people who are underbanked, that's just telling you there's a lot of poor people. Why would you want? How do you make money from providing financial services to people who don't have money?
I think it's the emerging part of the equation. Yeah, people talk about, or 10 years ago talked about 200 million people in India who are middle class, had some money to put in the bank. That number's probably doubled now,
Right.
And it's still only a third of the population. So it's just in terms of the runway, India probably has more runway than any other country in the world.
Thank you. Just can I get your thoughts around it? Is this whole area of sort of financials in India and the application of technology and the building out of digital infrastructure?
Well, I mean, I would echo the view that it's very, very exciting. I think Modi has cut a lot of red tape. So India is essentially going through an industrial revolution, which I think is attracting a great deal of attention around the world because it stands out so much. Mm-hmm. But we may be the only 3 investment people in emerging markets who talk about valuation in India. And that's what I find. I find remarkably few people try and talk about how do you price this, because everything looks fantastic. And we can see this economy growing. And quite frankly, it's important this economy grows because to an extent it balances out some weakness in the world economy and potentially a slower growing period in China. And that's important. But what you pay for that. And again, I think, at least right now, it's quite hard to find bargains in India.
But when you look back through that value lens across your career in emerging markets, how much stuff did you miss? That if you'd gone back and said, I know it was growthy, it didn't go through the Lazard model, but actually with the benefit of 20 years of hindsight, I really wish our idea of a PE was we bought at 14 rather than 12 or whatever it happened to be. And
well, I guess it comes down to process and how important process is. The answer is there are long periods when you might have wanted to own a given stock or a given area of the market, but for process reasons, you couldn't. And yes, does it hurt you? It can hurt you over that period. But at the end of the day, if you're following the process, what I would say is over very long time periods, I don't have that many regrets about not owning stocks.
Okay. We've got about 15 minutes left. We talked about 2 of the really, really big markets, emerging markets, but I want to get some thoughts from each of you. And I'll start with Dominic around perhaps some of the smaller markets where you're seeing opportunities. And Dominic, can you focus in on Greece? Because I'm having a look at your recent top 10 holdings on your fact sheet. Piraeus Bank, seem to have, what's the story there? What do you like about it?
The Greek story was one of these classic emerging market stories where things actually did change. The normal mantra is it's going to be different this time, and everyone says, no, it's never different. In Greece, we had a story where we had a change of government that brought in what I think is probably the best government and the best management of a country in Europe over the last 5 or 6 years. And they fundamentally changed the economy and the trajectory of the economy, and were helped out massively by 0 interest rates in COVID in a country that had a massive debt problem. But they had the people in government and in the right positions to actually take advantage of the 0 interest rates. And what we found when we went to Greece for the first time in the current cycle after the new government were elected in 2019 was that the whole investment community had effectively left. Greece had been an emerging market in 2012. In 2020, there wasn't a single piece of stock research on any Greek company by any global investment bank. And we understood the Greek market and the Greek banks from before. And we saw an opportunity where we understood what the government were trying to do. And each step of the way, in terms of recapitalizing the country and recapitalizing the bank, the banking sector, the government did exactly what they said they were going to do. So we had a situation where we had a banking sector in 2019 with 89% of the balance sheet in NPLs, to a situation today where you've got 3% of the bank's balance sheets in NPLs.
Sorry, NPLs?
Non-performing loans.
Yeah.
And all of the way along that journey, the government's goal has been to privatize the banks and make them properly private companies. And that has been evidenced over the last 2 years, particularly by Greek bank government holdings in the banks going from about 80-90% in some cases in the banks down to pretty much no investment, Greek government investment in the banks at all. They've all been sold to the private sector. the Greek government realized that was the best model for banks to actually then fulfill their purpose within the economy, which was to start lending money and enable the economy to grow. That was one part of the equation, a reform story that completely transformed a particular sector. The other part was that because the investment community generally was not focusing on these banks, valuations were and remain incredibly cheap. And to give you the example of Piraeus Bank, which is in our smaller emerging markets fund, the largest holding in the portfolio today. It's generating this year probably a 17% return on equity, and it's trading at about 0.5 times price to book. They're probably the cheapest bank that we can see out there in a country where we think the reform is actually sustainable.
Okay. Glenn, could you give us an example of one of the smaller emerging markets where you're seeing opportunities? It might be a stock, it might be a bit of a change to the economy that's going on.
Yeah, well, I've sort of top down. We do quite like looking in less popular places for businesses that might be trading at reasonable valuations. The Philippines is quite unpopular as a market. Brazil's had an extended period of very high interest rates, which has sort of led to quite significant derating of the fairly short list of good quality companies that are there. Mexico has had a bit of a correction on the back of elections, and there are one or two extremely well managed Mexican companies with long track records of both growing and looking after all of their stakeholders and shareholders. So yeah, I do think that it certainly pays to be looking across the whole universe.
Have you got an example? I don't know. Brazil, for example. What do you like there? What's thriving despite a high interest rate?
Well, there aren't that many companies in Brazil that have delivered real returns. I mean, we're investing on behalf of developed world savers who are trying to compound their retirement pot or whatever it might be. And so we're looking for real returns, and there aren't that many companies in Brazil who've actually been able to generate them. And the two sort of standout names in Brazil would be the leading pharmacy operator there. We quite like pharmacy as a sort of healthcare defensive sort of business model, as long as you get the right governance structure around it. But Raia Drogasil has a phenomenal track record of compounding growth and at very high returns as well, and not risking its balance sheet, but consolidating what's still quite a fragmented market and gradually growing, not gradually diversifying away from just sales of medicines, but also now starting to look more like what you think of when you think of a pharmacy here, more front of house type sales. And that's been a very strong compounding business that we think it trades at a reasonably attractive valuation that should meet our sort of absolute required returns. Another business in Brazil, just thinking about global leading businesses, you don't maybe associate Brazil with global leading industrials, but actually in the south of the country, there's a family-controlled company called WEG that began manufacturing electric motors in the 1960s. Today, it's a global capital equipment business based out of Brazil, but with operations in China, in Mexico, Turkey, India. So participating in the upgrade of grid all around the world. And again, this would be one of the few Brazilian businesses that's actually generated real hard currency returns. So yeah, I think it's about not compromising. It's about making sure the businesses that you're owning are genuine leaders, whether that's in global technology-based businesses like WEG or leading domestic consumption businesses like Raia Drogasil.
James, similar question to you, just an example of a stock or perhaps rather one of the smaller emerging markets. But as part of that, could you unpack, I mean, you were making the point earlier, as an emerging market investor, you're a minority shareholder a long way from home. When you're chatting this through why you like the company, can you just give us some indication of what are some of the things that management do that make you think, yes, this is a suitable home for my client's money?
Well, on that issue, I mean, the biggest single risk we discount for in our process is governance. And we've been doing it for more than 20 years. So alignment of interests is very, very important. And there, we, for instance, don't like employee stock options because that's actually a method of misalignment. We want management to own the same paper that we own, which is shares, and we want those to be restricted for a reasonable period of time. And actually, in a best world situation, they actually hold on to them once they've vested. And so we like that. We also look at how companies and how given managements have behaved in the past in terms of different situations that have come about and how they've treated shareholders. We do look at other areas like environmental and social costs and whether we think that is going to be a significant financial cost for investors to bear in the future. And we try and price that. Mm-hmm. So a little bit different perhaps from Glenn's strategy is that we do invest in government-controlled companies as long as after we've priced that risk, and that risk can be very substantial, and we've priced governance risk and other risks, that the stocks still give us competitive upside. Mm-hmm. So we will do that. So again, it's very, very stock specific. You know, the best example I can probably give you is that we've been relatively heavily invested in South Africa for a long period of time, during which, you know, we've had probably negative net returns for a good deal of that time until recently, because we've just felt that the opportunities in a lot of those stocks have been greater than what the stock market is giving us in terms of valuations. So, for instance, Life Healthcare is a hospital company, very well run. It's got lots of politics happening right now with a new healthcare bill that's gone through, but they do a very, very good job in what they're doing. And it's a good example of a company that we've had in the portfolios for some while.
Okay, we've got about 3 or 4 minutes left. So I wanted to start getting some final thoughts from each of you. I suppose my first one is just getting a little bit of a sense of how the markets in general are pricing risk, political risk in global emerging markets. We've got all sorts of stuff going on. I mean, the Middle East, there's obviously sort of China, Taiwan. I mean, nobody knows what's going to happen in any of these. We've got US elections. But is there a danger if you're an emerging market investor that over the next few months, everyone's going to think, you know, I don't know what's going to happen. Ultimately, I should just be in the dollar and stick all your money in a continental power that's in the middle of the system. It won't go wrong.
I think if you're a developed market investor, there's just as much risk of sticking all your money in the dollar, given where the major risks are right now. I think over the last year or so, I think markets are largely ignoring a lot of the geopolitical risk. Mm-hmm. You know, if you look about 2 years ago, we were worried about a Chinese invasion of Taiwan. You know, now we're worried about whether the Chinese consumer is confident or not. Mm. Complete sea change. A year ago, we were worried about a major outbreak of war in the Middle East. Now, maybe we still are, but the markets and the oil price are not telling us that the market is worried about it.
Yeah.
So I think, you know, maybe that's because of complacency, or maybe that's because the overall impact is not necessarily going to hit emerging markets more than developed markets. Mm-hmm. So we might as well carry on. And we have a lot of money in the Middle East, in the Gulf countries. And what has become very, very clear over the last year and sort of confirmed what we had thought is that the Gulf countries have no interest in getting involved in a Middle East conflict, whether the conflict is on their doorstep or not. So, and the oil price is telling you that they have no interest in getting involved in a conflict either. I think if you look at what's happening with Russia and Ukraine, you barely see it mentioned on the news anymore. I mean, maybe there's still a massive geopolitical risk. Maybe there's still the risk of further escalation of the war. But the markets are kind of telling you that the geopolitical risks have been ramped up by non-market players, let's say.
Okay, thank you. Kind of thought from you, if you were talking to potential investors today, why should they be looking or considering global emerging markets?
Look, we're talking to potential clients, existing clients all the time, and I try to show them the portfolio as a sort of a collection of cash flows, growing cash flows, and a very diversified set of income streams, both diversified across currencies. Some of our businesses generate dollar income, others emerging market currency income. These are franchises that have demonstrated pricing power over long periods of time, so real compounding, growing cash flow streams. So I sort of present it as a very diversified set of global cash flows that should be able to compound over time. And currently, appetite for EM is such that, or emerging markets is such that we're not operating at one of the most elevated valuation points of my career. I've certainly had periods over the last 20 years where you've almost been advising clients that maybe they should think about investing elsewhere because the appetite for EM is very high. That's not the case at the moment. So it's a very diversified set of globally, growing compounding opportunities, and very different, whether it's healthcare in China, soft drink consumption in West Africa, electrification in Brazil. They're very, very different, and I think therefore somewhat defensive investments as well.
Thank you. James, a final thought from you. If somebody says, I've got plenty of money in developed markets, should I be in emerging markets because it provides some diversification and defensive element? Or actually, if I'm going to take my money abroad, I need to get a higher return than I would from leaving it in domestic institutions. Which would you say is a better long-term reason to be in EM?
As long as they have a reasonable time horizon, I think emerging markets should be very much a part of the conversation. The diversification emerging markets give, as has been noted earlier, there are risks. There's no question there are risks. There are always risks with markets and with emerging markets. But this period right now is quite reminiscent of the period, say, 22, 23 years ago, when essentially people would say emerging markets gives you volatility and negative returns, and we don't want to be involved with that. And then we went through a whole decade of significant outperformance in emerging markets that I think surprised a lot of people. I wouldn't be surprised if we have a similar period like that.
We have to leave it there. Thank you so much for watching. Do stay with us. We've got some information coming up in just a second on how you can potentially use this as part of your structured CPD. Just remains me to thank our fantastic panelists here today, Dominic Bokor-Ingram, Glenn Finnegan, and James Donald. From all of us here, goodbye for now.